All right, so this chapter, chapter 11, talks about bonds, not James Bonds, because those are just sexist movies, right? What? Are you kidding me? You never watched him? He's just a womanizer, man. I mean, he's an awesome spy too, but anyway. Okay, he's just a cool guy and he gets all the ladies. That's not sexism, right? That's just James Bond is just awesome. Okay, but this is a totally different kind of bonds altogether. Okay, a bond from a financial sense is not a super secret spy with a license to kill. A bond from a financial sense is a liability, a long-term liability that we are borrowing money if we're the issuer of the bond. Okay, what makes it different from other types of loans is usually when I do like a note payable, I'm going to a bank or sometimes to a private party and saying, hey, will you lend me money? And then they lend me that money and I pay it back. A bond's a little different because a bond is a structured investment. So usually it's used either by corporations or by governments or by municipalities like school districts or things like that when they need to raise a big chunk of money. So what they do is they go to a company, usually a brokerage company like Edward Jones or Merrill Lynch or one of the big banks, and they say, we'd like to do a bond issue. And what the company does is it structures an investment. The idea is if a bank, I mean, if a company wants to borrow $200 million, most banks are like, whoa, that's a lot of money to loan to a single entity. So instead, what they do with a bond is they say, we're going to go get a bunch of investors who are willing to loan $1,000 a piece or $10,000 a piece. And so instead of borrowing money from one person, what you're doing with a bond is you're borrowing money from a whole bunch of people. From their perspective, it's an investment. They're giving $1,000 and they're going to get interest in return. And then at the end of the bond's term, they're going to get their $1,000 back. Okay. But to the borrower, it's just a loan. It just happens to be that they're taking this loan from a whole bunch of people simultaneously. So it's almost like the original crowdfunding, right? Like so that's how it works. So what happens is when you go to a bond transfer agent and you say, hey, bond transfer agent, we would like to structure a bond issue. We want to borrow $200 million. What they do is they go out and they look at the prevailing interest rates for bonds at the bond market. Okay, and by bond market, I mean there's an actual market, not like a place, it's electronic really, but where people can buy and sell these bonds. So if you were to go to your broker at Edward Jones and say, I want to invest in bonds, that broker could pull up and see what bonds are available for sale and purchase bonds for you. Okay, so they go out and see what the interest rate is, what other bonds are paying. Recognize that the bond market works. It works in such a way, and really all borrowing works in such a way as to we're trying to bring together someone willing to loan money with someone who wants to borrow the money, and then we're saying, well, how much interest are you willing to loan your money for? And we're saying to the person who wants to borrow, how much interest are you willing to pay? And it reaches like this equilibrium point. There's some point at which if the interest rate gets too high, the lenders go, I mean, the borrowers are saying, I don't want to pay that much interest on it, so I'm not going to borrow if interest rates are too high. And there's a point at which the lenders say interest is too low. It's not worth it to me to loan out my money for that low of interest. And so when you do this on a large scale market with millions of potential investors and hundreds of potential lenders, it reaches an equilibrium point, right? A point at which this party is willing to lend the money for this amount of interest, and this party is willing to borrow and pay that amount of interest to borrow it. So that's how bond prices and bond interest rates get set, okay? So what happens is you draw up your bond issue and you say, these bonds are gonna pay 4%. So the investors, knowing if they buy it, they're gonna get 4% interest on their bonds. The lender, the person who, the investors who buy it are the ones who are lending the money, and the borrower knows they're going to have to pay 4% for that money, the bond issuer. Okay, but what happens is usually the entire bond issue doesn't get sold in one big chunk. In other words, it's hard to find $200 million worth of money all at once. So the bonds get set at 4%. And in the meantime, the market interest rates are still fluctuating. Okay. Sometimes the market will be paying a higher rate of interest than what the bond is set at, and sometimes it will be paying a lower rate of interest. Also, bonds are tradable. So if I purchase bonds and I'm holding these bonds that pay 4%, and then I decide I need the cash, I could find someone else who wants them and I could sell them to him. What's the appropriate price? Well, depends on how much interest rates have fluctuated. Because if I have 4% bonds and now new bonds are coming out paying 5%, he's not going to want to pay full price for a 4% bond. So I might discount that bond and sell it to him. Instead of for $1,000, I'll sell it to him for 900. And so I'll get 900 cash and I'll be happy. I lost 100 on the deal, but I got my cash. He gets something that he purchased from me for 900, but it's still paying 4% interest on the full 1,000. And when it comes due, he's going to get the full 1,000 back, which will make him. So it's a little bit complicated, but I want to step you through the process. So when we issue bonds, we can either issue them at what's called a discount, or at face amount, or at a premium. And what we mean by that is sometimes we issue a bond for the exact amount that is printed on the bond certificate itself. That's the face amount. So if the market rate, in other words, what bonds are paying all over, equals the contract rate, the amount the bond is paying, then our selling price is going to equal the face amount. And that's going to be considered selling a bond at its face amount. But if interest rates at the market interest rate fluctuates up so that the market rate is greater than the contract rate, then the selling price on the bond is going to be less than the face amount. So we're going to sell it at a discount. The logic behind this is that, like I just explained, if I've got a bond that's paying 4% and all of the new bonds being issued at the market today are paying 5%, no one wants to pay full price for the 4% bond. No one wants to lend their money at 4% if they could get 5% over here. So in order to induce them to lend their money, I'll have to discount the bond, sell it for a little bit cheaper, so they'll be earning better interest on their money. Okay. If you can't remember this, just remember that you can remember the rule, and the why of it will come as you work with it. Okay. The rule is there's an inverse relationship between market interest rates and bond prices. Recognize that contract rates are fixed. That's the rate that the bond pays is printed on the bond. In the old days, they had like hard paper certificates. And once that rate is printed on there, that's not going to change. And the face amount of the bond is printed on the bond. This bond's worth $1,000. Once that's printed on there, that's not going to change. So what does change is the market rate and the selling price of the bond. As market rate goes up, selling price goes down. If you can remember that happens that way, the inverse relationship, then the why will come. Okay.
How long do bonds typically last?
Yeah, so you can get bonds from all different maturities. You can buy a 1-year bond all the way up to 30 years. Typically, I've seen a few longer than 30, but 30 is usually the longest. Yeah.
So you won't get your money back for 30 years?
Right. So you'll get paid interest on it usually bonds pay interest every 6 months. So you'll get interest on it every 6 months for the next 30 years. It depends on the face value of the bond and the face rate of the bond. Okay. So bonds are usually issued in increments of $1,000. So let's say I was a wealthy person and I could buy 100 bonds, $100,000 worth. If the bond was paying 6%, then I'd be getting $6,000 a year in interest. So I'd be getting $3,000 every 6 months. Believe it or not, when I was a broker, I focused on bonds. I was in an older community. People like bonds because they're safer than the stock market. They don't fluctuate up and down nearly as much. And so we would I would have clients that we would get bonds that pay every 6 months. So we'd take $600,000, chump change, right? 600 grand. And we would put $100,000 each into a bond issue that had different semi-annual payment dates. And at the time we were getting about 6%. So think about it. If you put in 100,000 and it pays you $3,000 every 6 months for $600,000, if we staggered it out right, they were getting $3,000 a month, and their principal was staying protected in the bond. A lot of bonds are so they're backed by the person who issues the bond saying, we promise to pay you. But to make it even safer, many of these bond issuers, what they'll do is they'll buy insurance. And so the insurance says, if this company who's issued this bond can't repay, then we'll repay. And so like a AAA rated insured bond, corporate bond in America, has never in the history of bonds failed to repay its principal. Sometimes it has failed to pay the full interest. Let's say the company fails and says, we can't pay this. The insurer comes in and just pays it off and says, here's your money back. But that's a pretty safe investment, right? In the history of doing it, 120 years, something like that, never has it failed to pay if they're insured. Yeah. Sure.
So what happens, I'm going to be negative here, but what will happen if the market crashes? Then
Yeah, so if there was a catastrophic failure of the market, meaning the company that borrowed the money from all the investors tanks and they can't repay, and then the insurer also tanks, right, and says, we can't repay, then it might be the first time in history that, I mean, it does happen, right? People lend money to people or borrow money from people and then say like, hey, I can't pay you back. And at that point, if you take them to court and they really don't have any money, what are they going to do? Usually if it's a corporation. So I'll recognize that if a corporation fails, then what happens is they go into bankruptcy and they go into what's called liquidation, where they take all the assets of the corporation and they sell them, usually to other corporations. Or sometimes another corporation will just buy that one out completely and assume their debt. But if they go into liquidation, then what they do is they sell off all their assets, and that creates this pool of money, and then they pay off the obligations of the company in a certain order. And debt is the first thing. The stockholders are the last ones to get their money because they're the owners, and therefore they were taking the risk of being owners. Okay, but debt holders, like people who are holding bonds, they're first in line. So there's always risk involved in all securities. From our perspective as accountants, what we need to know right now is that contract rate and face amount, those are the amounts printed on the bond, the amount of interest that it will pay and how much principal on the loan it's paying, okay? Those are fixed, and that market rate of interest can fluctuate based on just changes in the bond market, and therefore the selling price of bonds can fluctuate, and that they have an inverse relationship. So as market rate goes up, the selling price goes down, and we call that selling the bond at a discount. If we ever sell a bond at an amount less than its face amount, we call that a discount. Conversely, if the market rate goes down, so the market rate is less than the contract rate, then the selling price of the bond is going to go up, and we call that selling a bond at a premium. And then when the market rate equals the contract rate, we call that selling it at its face amount. Yeah. Yeah, the big difference is that government bonds are considered safer because they have the full credit of if it's a U.S. government bond of the U.S. government behind it. Again, U.S. government bonds have never failed, but they were downgraded about 10 years ago with all these fights in Congress about reappropriating each year. Moody's, there's these Moody's and S&P. You maybe heard of either of those, or maybe you haven't. These are two companies that are, what's that? Okay, they're bond raters, among other things. So what they do is they hire analysts, they study bond markets, and then they say, hey, if this company issues a bond, it's a AAA bond. That's the highest rating they can give, meaning they've never had any problems paying back, and they look like they're in solid financial condition now. US government bonds have always been AAA rated, but they were downgraded to AA several years back, just because there was like this possibility that Congress could fail to act and the government couldn't pay. The bad thing about being downgraded as a lender is it means you have to pay higher interest when you borrow, right? The same reason if I go out and get a credit card today, I'll probably pay 11% interest and you'll probably pay 20, not because you're necessarily a greater risk, but because you have less history and you're younger, they're going to assume you're a greater risk, right? So the US has never failed to pay, but because we've had arguments that have got us close to being in failure, they've downgraded us. So the bond market is a really broad and complex thing. It was actually when I was studying for my brokerage license, the hardest thing for me to wrap my brain around because I'd never dealt with it before. And then I ended up really specializing it and selling tons of bonds to tons of old people. It was great. Make 3% on those, right? So if I sell 100 grand worth, I get $3,000. So if I sell 600 grand, 18,000. One time I had this old rancher and he was always teasing me about how many kids I had. And he think he bought $700,000 in bonds from me. And he goes, and he goes, what do you feed all those kids of yours, Mike? And I said, well, mostly chicken because it's cheap, right? Like I got 8 kids. So, and then he goes, how much did you make on this transaction? And I go, I made $20,000. And he goes, maybe buy your kids some steak tonight. It came from the cattle industry. Maybe you should support the cattle industry. But that doesn't happen all the time. By the way, okay, just so you know, before you get an idea of going to be a broker, I had other months where I made $58 for the whole month, right? But after that one, you walk out of the meeting all cool, and then you call your wife, and you're like, I just made $20,000. Yeah. No, then you think, oh, I made $20,000. I can spend money like crazy, and then you're out of money again. So instead of being like, I'm going to take all this money, what I should have done, right, is put it into like a savings account, and then just taken like a salary of like $4,000 a month off of that or something. But at the time, I was young and reckless. All right. Bond prices have an inverse relationship to the market interest rate. That took us a long time to get there. All right. Oh, click. There's a door there. I see none of you wore pajamas for pajama day. No, that's not pajamas. My son had full body like chicken onesie, like a rooster chicken onesie. I tried it on. It was a bit snug, so I didn't wear it. You're welcome. All right. So again, that's just I guess this was a picture of it. This is just a verbal description of the same thing, okay? If you're more of a verbal person, I think I've beat that to death, so we're gonna move on. So we're gonna look at the process from an accounting standpoint of what happens when we do this. So we're gonna start with issuing bonds at a face amount. So here we go. We have a company called Eastern Montana Communications. They issue the following bond. So they're gonna make it a nice even amount for us because they're nice. So they issue these bonds with a face amount of $100,000. The contract rate of interest is 12%. Give me some of that. I will buy that bond right now. The term of the bond is 5 years, and the market rate of interest is 12%. So here's a scenario where the contract rate and the market rate are the same, which means we're going to issue these bonds at face value, okay, or at face price or whatever they call it in the other one. So to issue it, it's going to look like this. We debit cash, we issue, and then we credit bonds payable. Looks like a regular payable entry, right? Our cash goes up and our bond payable goes up. And then a note if you want to. So then every 6 months, this bond is going to pay interest, okay? It's nice when the bond is issued on January 1st, because then it's going to pay interest in June 30th and again at December 31st. If it's issued at any other time, we're going to have to make one additional entry at year end to show the interest that's accumulated, but that we won't be paying until the next payment. Okay, so we're going to have to do an adjusting entry at year end, and you'll see that when we do some other examples. All right, so always throughout its life, it's going to look like this. We debit interest expense, we credit cash. That's the transaction for interest payment. And then at the maturity date, we do an entry that debits bonds payable. So bond payable goes back down to 0 and credits cash. So that's pretty simple in the sense that that's all that happens is we get the cash and we owe the money. We pay interest every 6 months, just like this. At the end of the bond's useful life, we pay the cash back and get rid of the bond payable. Easy. okay? Sometimes though, we get bonds that are issued at a discount. So here we have a bond who has a face amount of 100,000, contract rate of 12%, the term of the bond is 5 years, and the market rate of interest is 13%. So remember, market interest went up, so the price of the bond is going to go down. So we're going to issue it at a discount. So because of that, we're going to sell this bond for $96,406, but our bond payable is still going to go up by 100,000. So remember when we talked about discounting notes? Well, with bonds, it's actually how they do it, okay? So we issue it, we only get this much cash, but at the end of its life, we're going to pay back a full 100,000. The difference there is called a discount on the bond payable. And this discount over time, if you think about it, is going to become an expense to us, right? Over the bond's life, this discount is going to become an expense. Why? Well, because we borrowed this much, we got this much cash, but we have to pay back this much cash at the end. So this difference is this going to be part of our interest expense. It's part of the cost of borrowing the money. So what we have to do is we have to amortize that interest over the life of the bond, or amortize that discount over the life of the bond. Amortize is just a big fancy word, kind of like depreciate, which just means to spread something across a longer period of time. Okay, like don't let the word freak you out. So every period, a portion of the bond's discount must be reduced and added to the interest expense. So the entry is going to look like this: interest expense, the debit, the discount on bonds payable is the credit. And typically it's going to look like this, where we have an interest expense debited, a portion of that discount. Remember, the discount had a debit balance, so we're going to credit the discount, and then we're going to credit cash, the amount of the actual interest payment we make. And our interest is just going to be the total of how much cash we're paying in our regular interest payment, plus the amount of discount that we are amortizing or writing off during each of those periods. The way we figure out how much to do that, we just say, okay, so there's two ways, right? The straight line method and the effective interest rate method. The effective interest rate method is required by generally accepted accounting principles, blah, 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 blah. Okay, so you can read that. I won't read it to you. So what we're going to do for this class is we're going to use the straight line method, okay? So we know that for this bond, there was $3,594 in discount at issuance. That was the difference between the price we issued it at and the face value of the bond, okay? So to figure out the amount we're going to amortize in each period, we're going to take the amount of discount and divide it by the number of periods. The bond pays semi-annual interest. So in a 5-year bond, there'll be 10 semi-annual interest periods, okay? Semi-annual means twice a year, if you're not familiar with the term. So they're going to amortize $359.40 worth of discount with each interest payment of the bond. So this is what the journal entry will look like. We're going to credit $359.40 in discount on bond payable. We're going to credit the $6,000 in cash. That $6,000 comes from the face value principal times the rate times the time. For time, you don't have to do 6/12, so you can just do 1/2 because the bond pays half of its interest in one period and the other half in the other. Okay, but you can do 6/12 if it makes you feel better. So that's the same principle we've learned in other notes payable. And then the interest expense is going to be the sum of the two. So what's happening here is by the end of the bond's life, we'll have fully amortized this discount. The discount, which had a debit balance of $3,594, will be by doing this 10 times, debiting it means the balance of it will be 0 by the end of the bond's life. And then all that will be left on the bond is its face value, and we'll pay that off when we get to maturity. Sometimes, though, we issue a bond at a premium. That means that the bond, that we're selling it for more than its face value. So here we have $100,000 face value, contract interest rate 12%. The market interest rate is 11%. Okay. So when we issue this bond, we're going to sell for, or we're going to get 103,769 in cash, or we only have to pay back 100,000. So the difference is called a premium on bonds payable, and you'll see that on the credit side. Okay. As we amortize that premium, it's going to actually reduce the amount of our expense. So again, the entry to amortize premium is going to be a debit to the premium and a credit to the interest expense. Remember, expenses increase with a debit, so crediting the expense is reducing the amount of expense we're paying. Okay. So let's look at our example. The premium is $3,769. It's a 5-year bond with semi-annual interest, so it has 10 interest periods in its life. So we're going to pay, or we're going to amortize $376.90 worth of premium each interest period. And so our journal entry will look like this. We're going to credit cash. Again, cash we figured out by taking the face value of the bond, 100% or 100,000 times the rate, 6%. So I guess this one's doing a full year. Or was it 12%? It was 12%. Okay. So it's 100,000 times 12% times 1/2, right? So we're getting $6,000 in interest payment that we have to pay out. We're not getting it, sorry. We're paying that out to the borrowers. And then we're debiting the premium on bond payable. And then the difference between the two is the amount of our expense. So think of it this way. If I issue a bond at a premium, because I got extra money up front, then the amount of my total cost of borrowing the money is less. Because I got 103,000, but I only have to pay back 100,000. If I issue a bond at a discount, then I got 97,000 and have to pay back 100,000. My total cost of borrowing that money is actually more. Okay. So that's the process we're going through. All right. Sometimes the issuer of a bond will redeem the bond before maturity. So you were saying, how long do they last? So like on a 30-year bond, sometimes, especially if say market interest rates have changed a lot, say they've dropped really low. So if I issue a bond at 6% and then the market interest rates drop to 2%, it's killing me to sit there and pay 6% on it. So they'll write a provision into their bond saying, we can call the bond, that's the term they use, which in essence means go back to the people and pay them off, okay? So a lot of times what they'll do is they'll issue a new bond at 2%, take the proceeds of that and pay off the old bond that was paying 6%. And so when you buy a bond, you have to look, is it callable? And if so, how long am I guaranteed to get this interest rate? Especially if you think you're in a period of falling interest rates. Anyway, so the corporation may redeem or call the bonds before they mature. That's all the things I just said. So usually when we call or redeem a bond, we're doing it at a price that's different than the face value of the bond, or even different than the book value of the bond, which is, remember, so the book value, if you remember back to like depreciation and other things, is just the difference between, or I think they call it carrying value in this one. But the idea is it's how much I owe minus any premium or plus any discount. Okay. So let's just look at an example. So on June 30th, the corporation has the following bond issue. Has a $100,000 face amount on the bonds and a $4,000 premium still out there on the bond payable. So assume that on June 30th, the corporation redeemed 1/4 or 25% of these bonds for $24,000. So this is what the entry would look like, okay? Remember, bonds payable are liabilities, so their normal balance is on the credit side. So when I pay it off or redeem it, I'm going to debit the bonds payable account. So I'll debit $25,000 worth of the bond, and I'll debit the premium on the bond payable. I'll credit the amount of cash I had to pay to do it, $24,000, and then the difference between all of those is either going to be a gain or a loss. Okay, so in this case, in essence, I'm getting rid of $26,000 worth of bond, but I only had to pay $24,000, then I made a gain of $2,000 on it. If you're not sure about that, again, if you do all these entries first, because if it tells you all of this, right? It tells you had $25,000. So it tells you it was a $100,000 bond and you were paying 1/4 of it off. So 100,000 divided by 4 is 25,000. So you know that's the amount of your bond payable that's going to go down. You're getting rid of that much of the bond payable. You also know the bond had a premium of 4,000, and since you're getting rid of 25% of it, 1/4 of that 4,000 is 1,000. And you know the balance of these, of the bond payable and the premium, are on the credit side. So to get rid of them, you have to debit those accounts. All right. Then it also tells you in the problem how much cash you actually have to pay to do it. So whenever you purchase a bond, there's like printed on it are like the rules of it. Like they can call it for this price at this date. And so in this case, they were able to call for $24,000. So that's the amount of cash that they have to pay out in order to pay off or call that bond in. And so then all you have to do is look at the difference. And if you need to put it on the credit side in order to make it all balance, that's going to be a gain. And if you have to put it on the debit side in order to make it all balance, that's going to be a loss. So you can do it that way, or you can like try to like work it all out and figure out if it's a gain or loss. I call it the journal entry method. And I enter all the information I know and then say my gain or loss is my one I have to calculate. And if it's on the debit side, it's a loss. If it's on the credit side, it's a gain. And the way I remember that is expenses are debited and revenues are credited. And a gain on the sale of a bond is a form of other revenue. And a loss on the sale of a bond is a form of other expense. Okay, so that's my process. You might, do what you want. So then the corporation calls the remaining $75,000 of outstanding bonds, which are held by a private investor, for $79,500 on July 1st. So the entry there, we would say, okay, we know we still have a credit to bonds payable of $75,000. So to call it, we're going to debit bonds payable $75,000. We're going to debit the premium, the other $3,000 of premium. Then we're going to credit cash, the amount of cash we have to pay out. And again, so I would skip this step and start with the stuff I know. I know how much the bonds payable, the premium, and the cash were. And then whichever side I had to post this on to make this thing balance, which in this case is the debit side, I would do. And by debiting, I know that I have a loss. It's an expense to me. Okay, that's the process for bond redemptions. Here's how bonds often get reported on a balance sheet. Depends on the size of the company. So either you'll see current liabilities and then long-term debt obligations. And then down in the notes, they'll break down all of the different specific bond issues. Or if a company only has like one single bond issue, sometimes they'll just be listed as a bonds payable up in under the long-term, non-current liabilities. You'll see that both ways when you look at a balance sheet. All right, so we have one new ratio to consider during this chapter. It's called the times interest earned ratio. And it just takes our income before income tax plus our interest expense and divides it by our income expense. I don't like that. I think that's, I'm going to look that up. I think it's net income. Let's see. Yeah, I don't know what income expense means, so I'll look that up to you for you.
Interest expense. Wanna look-
You-
wanna look.
Yeah, no, because something's weird about that. I pulled that off of the publisher's slide deck and it doesn't look right. Okay, interest expense. So it's income before plus income interest expense divided by interest expense. So in essence, what you're doing is you're taking your net income before income tax, you're adding interest expense back in, and then you're dividing the whole thing by your interest expense, not income expense. And what this does is it tells us, it's like saying, how many times the amount of interest expense I have to pay is my total earnings, okay? If that's really low, it means that a company has too much debt. It means that they don't have enough money coming in from their net income to cover their interest, and that's a bad place to be. Okay, so that's what this is used for. Well, that's what it says. If it's less than 1, it suggests the firm is unable to cover interest payments. If you can't even cover your interest, let alone your principal payments, you're in trouble, right? All right, so that's that. There's a whole appendix in this chapter about the time value of money. You can look at it if you want to. It's like things like future value, present value. If you've ever learned about those concepts, they're pretty complicated. We'll probably spend some time in them in accounting too, but not so much in this chapter. So just so you know, if you're looking at the book, there's a whole nother appendix at the end of the chapter that does another concept that we're not going to cover. Okay, this is one of those chapters that seems a little hard from the explanation. And once you start working with it, it's pretty doable. Okay, it's like when someone tries to explain a new card game to you, and they're trying to tell you all the rules, and you're like, I don't know, and then you start playing it, and you're like, oh, okay, I could do this. So, you know, I can tell by the quietness of the room that people are like a little bit like, okay, this seems complicated. So what I'm saying is, don't sweat it. You're gonna be fine. All right, any questions? All right, and have a great day. People are like, I have lots of questions. I just don't know how to formulate them into an appropriate question yet well, that's why I've always thought, like, when you learn, you get new material, you don't know yet, and unless you've really read it deeply ahead of time and you've like made notes, but usually you're just like, I got to process this before I can ask questions, which is why we do the guided problem and then have the day where you can ask questions. All right. Remember who you are. Make good choices.